Welcome to the Daily Update. This is being prepared Tuesday, April 26th, where we'll look at the action in the market today and then see how things look for Wednesday, April 27th. And it was another pretty negative day. A lot of technical damage was done. We broke through some support levels. We're getting down to other lows that we've hit before. And the big question now is, can we maintain those lower levels? Are we just testing them before we get ready to go higher, or are we going to break through them? But right now, everything is looking pretty negative at this point. So let's go back and talk about the day. We had a gap lower right at the open. Things just, again, started off by being very negative, and we actually opened to below the daily pivot, which was at about 42.65. And I say about because there are decimals after this, and sometimes I round up or round down. These aren't exact numbers. They're exact numbers on the charts that I look at, but not what I put here. Selling then quickly took place to below S1, which was at 42.31, which is interesting. That was a support level yesterday. You don't see that very often. And then we went about to yesterday's low. That was kind of the line in the sand. Could we maintain the low from yesterday? No. We bounced around a little bit. S1 then became resistance as prices chopped between S1 and yesterday's low. So we're like a ping pong match. This is a little bit more negative. Instead of dropping and then seeing a pretty significant bounce from that, we really didn't see that. I was watching prices as things were happening, and we would go lower, and we would just kind of stay there and then chug a little bit higher, then chug a little bit lower. You're not seeing a lot of buy the dip right now. People are really concerned about this. They bought the dip 100 points ago, 200 points ago, and now they're either booking losses because they're selling and getting out, or they're afraid because they're in positions that are significantly losing right now. Then as we got closer to the close, we saw some more late day selling, and we finally ended up breaking below yesterday's low. That was kind of the point that really made things more negative. We ended up being down 2.81% on the day. If there is a positive thing to say about this, is that volume was slightly below average. It's still pretty high, and there's still a little bit of conviction here. And I say a little bit because we are a little bit below average volume. But it's negative nonetheless. First, we have to look at price, then we can look at volume. Right now, our technicals are really negative across the board, and that's what I'll spend the rest of this video going through and showing you. What's also really feeding into the market is either real or perceived inflation, because yesterday interest rates actually fell, and that didn't give any support to stocks. They went down just like interest rates did. But bonds have been really oversold on a price basis, so they've been due for some kind of a bounce. But to see yields go down and stocks go down together, that's pretty negative right now. We have a lot of the geopolitical concerns, of course, Russia, Ukraine. There's been some hyperbole, I hope, that says if the U.S. keeps supporting Ukraine by sending them weapons, don't necessarily count out some kind of a nuclear response, and that could get ugly really fast. We really don't want that to happen. Let's hope it was just scare tactics. Because I grew up during the Cold War, and it didn't really bother us. We didn't really think about it day to day, but it was always in the back of our mind. And the little duck and cover exercises that we would do at school, well, even when I was quite young, it's like, okay, this isn't going to help anything at all. But let's just hope it really doesn't come to that. There's been a lot of speculation about Putin's current either mental or physical state. There was I saw something where he attended midnight mass for the Orthodox Easter, and he didn't necessarily look decrepit, but he didn't look all that great either. But I'm not a doctor, and there's people speculating about his current state. And then getting back to the markets, we have earnings that are coming out, and sometimes this can help the market. Other times it can hurt the market. Other times the market doesn't really care. So at least that's kind of where we're at right now. The market has just decided it wants to go lower, and then it uses anything as justification for that. So what are some comments we can make? Interest rates declined, but so did growth and tech. We haven't seen that in a while. And that relationship between interest rates and tech we're even losing that more. And I'll show that at the end of the video. Oil did get back to over $100. Technicals are negative. I've said that 3 times now, and then I'll go and prove that as we look at the charts. We're still in correction territory, and the 10 to 5 yield curve is still inverted. Now, what about the economic reports? We had a lot of them, and some of them had a bit of an influence, but we're seeing some differences in our economic reports. Consumer confidence did decline, not surprising, but it wasn't necessarily more than expected. So the market already had anticipated that. New home sales decreased. Durable goods increased after we saw the slowdown back in February due to the Omicron shutdowns and things. The housing price index increased, and the Case-Shiller home price index also increased. Now, getting back to our trend, we're still at that same place. We're looking at the ADX. If you use it more aggressively, you are already in a trend, and that trend is negative. We're still below 20, but we're getting close. We're at like 19.53 or something like that. Another down day, and we would definitely cross above 20. So our trend is negative, but still possibly developing. Our bias is now negative, and our momentum is negative. So let's go back and look at the day's session. First at sentiment, we're getting a little bit more extreme as far as fear is concerned. And I don't know what to make of these charts. I look at them 2 or 3 times throughout the day, and it seems like they change every time. So I don't know if they try to update these things on a somewhat real-time basis. I usually just wait until hours after the market is closed and then use those charts. But it says yesterday we were at 27. That's not what I was showing in yesterday's video. So again, this is a free tool that we have access to. It's not like we can get our money back or anything. And then here's the historical look. We're getting lower, but when we drop down below, especially when we drop down below 20, that's when we're seeing a lot of real severe fear at that point. But we've bounced from this level before, if you look back at the chart. So this can change at any time. The VIX really spiked up, both on a closing basis. Here's the line chart on the top, and then here's the bar chart. And we pretty much closed at the top of the bar. Then here is another study on the VIX. This is taking a 9-period RSI and plotting it on the movement of the VIX. And it's showing that we are showing an extreme fear reading right now. Now, it hasn't turned over yet, and this could still go higher, but we're in that area where the VIX is really spiking up. Then looking at the VIX of the VIX, as you can probably imagine, we saw a gain both on the bar as well as on the closing basis. So we're seeing pretty much fear across the board now starting to come into the market. But we've been at higher levels than this before. Just because we're spiking up doesn't necessarily mean we can't go higher. At the same time, it doesn't mean that we might turn and go down if we have an up day. Then the Ulcer Index, it advanced a bit, but we're not really spiking as well. And then I have a longer term version of this chart where I possibly will bring that out in tomorrow's video just to show you other extreme readings that we had over a longer period of time. There's really no set upward boundary as far as this indicator is concerned. The equity put call ratio, after really spiking up on Monday, on Friday, we really recovered some of that on Monday, only to bounce back up again. And we've been at these levels before. This is just one part of the overall puzzle that is used in the Fear and Greed Index. Looking at the sectors, 10 out of the 11 were negative, and I sorted these according to what had the most loss. Discretionary just got hammered, down over 5%. Tech was down almost 3.75%. Communication, these are the three culprits that have been really dragging the markets lower lately. The only sector that was up was energy, and it was just barely up on the day. Here is going back to the all-time high, showing energy, utilities, and staples, which these are more value plays. Then at the other end of the spectrum, we have the usual culprits. Communication, discretionary, tech, and even financials are starting to show some weakness right now. And this is not necessarily a surprise, but these kind of jockey around for what's doing the worst and second to worst and so forth. So they can change over time, but we're looking at trends usually. Here's the tech sector itself, down 3.73% on the day. And this is not a good-looking chart right now. We broke below the previous low on a closing basis. Now we'll have to see, can we get some other support at any of these other levels? Here's the semiconductors, also down 4.43%, really showing a breakdown after having seen a recent death cross. As far as inflation, the CRB index was up 1.38% and in an overall strong uptrend. If you want to pause this, you can see the different parts that make up the CRB index and why I use this as one of the inflation gauges, just to see how does inflation look. Here's the CRB to the S&P 500. The CRB has been really outperforming, where here it shows the S&P has been underperforming. Now, as we get closer to the Fed meeting, I'm going to be showing these charts pretty much every day, and they're going to change a little bit all the time. These are based on movements in the bond market, and they've worked up some kind of algorithm where they can figure out, based on where things are at and how things are moving, this is the probability of where interest rates should be. Well, as of right now, it looks like there's a 94.3% chance that we will be at 0.75% to 1% after the meeting on May 4th. And that's pretty much what we're expecting. That's 50 basis points or 0.5% from where we're at right now. Here is the historical chart. If you want to go back and see how these different ranges have jockeyed over a period of time. Looking to the June 15th meeting, there's a 74% chance that we'll be at 1.5 to 1.75. So see how this is changing a little bit? And this is just showing also how things have changed over a period of time. And they will continue to change. Then looking at the July 27th meeting, right now there's a 69% chance that we will be at 2 to 2.25% after that meeting. And here's the historical chart to go with that. Then one thing that comes out right before the advanced GDP report comes out is a thing called GDP Now. And this is, I believe, the Atlanta Fed that puts this out. And they just try to guess at what they think GDP is going to be. Well, and you can see they get it wrong a lot. But right now, they have it at 0.4459 for the first quarter of 2022. We'll have to see how close does that come in to what the report actually says. Here's another screenshot that I took. The latest estimate is 0.4% as of April 26th. And it's updated every week. I usually don't show this because this can be kind of weird to figure out what all of this means. I tend to look more at this previous chart. But this just shows how, taking everything into consideration, they try to come up with what they think the forecast is. Sometimes they're right, sometimes they're way off in their forecast. Technical alerts, we had a slug of them, and pretty much all of them were negative. Started out okay. The NASDAQ was over 13,000, then got down to 12.9, and then we saw a whole bunch of negative things. I'll just look at the S&P, where we broke below 4,200. A lot of sectors are really registering some negative signals. The NASDAQ continues to drop. Oil got back above 100. I'll show a chart of that. gold was able to get above 1900, and then the dollar yet again set another 2-year high. So let's look at the day. Way over on the right, you can see we had the gap down and we actually dropped below the pivot right at the start, and we just kept going down to S1, kind of rested there for a little bit, fell below S1. Well, now that we fell below S1, it became resistance. So anytime we tried to get back above S1, that just wasn't happening. There just wasn't the buying power to be able to do that. So we dropped a little lower, chopped sideways, and then as we got closer into the close, we saw some more late day selling, and we closed just about at the low, pretty much at the low on Tuesday. So that's pretty negative overall. Here's how it looks on a bar chart. We had been above this intermediate term support. Well, we lost that again, and then we broke below this pivot point as well. And so now we're starting to see some previous lows. Are we going to test these before we go higher, or are we just going to blow right through them as we go down to even longer term support? That's kind of where we're at right now. We're currently down 12.95% from the all-time high, so we're definitely in correction territory. I have the all-time high marked up here, and then the latest close with the little red line over here. We are pretty far away from the 200-day simple moving average and getting further every time we have a decline. Looking at the growth versus value, not hard to figure this one out. Growth underperformed, value outperformed on a relative basis. This shows how growth did not do well. This shows how value had a good day. NASDAQ 100 underperformed the rest of the S&P 500. Here's our pure growth index, which was down 3.62%. Our value, it lost, but it only lost 1.88%. So it did better on a relative basis. And then here is a combination of the two, just showing how growth has really been decreasing, both on an index basis, and these are a couple of ETFs that I take a ratio of those as well. Here's the S&P, just how it's underperformed the growth ETF. As far as our trend, this is kind of what we're really watching now. Here, the black line is the ADX, and I guess it's 1963 right there. We're just below 20. If you're more aggressive, you're looking at this as a trend already, and that trend would be negative. Even though we saw a little bit of a decline with the red line, it's clear that the trend is negative right now. So if you do any shorting type strategies where you ride the trend, whether you buy puts or do anything like an inverse mutual fund or an inverse ETF, you might be interested in doing that. But be aware that we're getting oversold and we're possibly at support as well. Our Arun shows that sellers are in full control, buyers continue to decrease, and so our oscillator is declining overall. Really no change on the decision point scorecard, just showing that we're either neutral to negative in the short and intermediate term. Long term, they still think is looking good, where I'm saying the long-term trend is negative because we're below the 200-day simple moving average. Looking at breadth, and I have I think a couple of new charts in here, just showing how we saw a real decline based on price, but see how we got down to this red line? But we got down to that red line on Monday too. That could be an extreme negative reading, but now we're seeing another one. Then based on volume, we're also seeing pretty significant declines. Our advanced decline line is declining right now based on price and going below the moving average, where based on volume, we continue to go lower and have been under the moving average for quite some time now. Advanced decline ratio is also declining and below zero. New highs and new lows shows that we set a whole lot of new highs, a whole lot of new lows. And then looking at the index right here with a 5-period simple moving average just shows that we are trailing off. This is showing a lot of internal weakness. Our 10-day moving average differential is also declining. So we're seeing more of a downtrend with that. Here's one of the newer charts where I just take the new highs and minus the new lows. We're down at minus 42. And sometimes this can show a bit of an extreme reading. Now, we can go a lot lower than this, but there have been times when this marked some kind of a low in the market. But beware, we could really spike down as well. Then here's the advanced decline ratio, which is, it was extreme negative after Friday. We bounced back up, and now it has come back down into extreme negative territory. And then this is a little bit longer look. This is taking a 19-day exponential moving average of the advanced decline ratio. It's a 19-day average of this chart that I just showed you right here. And it's not giving us an extreme reading right now, but it is decidedly negative. This would suggest that we might have more room to fall. But there's been other times when we got about to this level, and that marked a bottom. That's why I don't use just one indicator. We look at a whole slew of them and then reach a consensus. That's why I call what I do is the consensus approach. Accumulation distribution shows that there's a lot more selling than buying. We declined and we're below the moving average, with the moving average starting to roll over. Short term, we're way beyond the 20 moving averages. Our 20s are starting to get down to extreme negative territory. 50 period is showing a decline. 200 period is also declining right now. As far as our different moving average spaghetti tree here, we're way down here. We're well below any of the plotted moving averages. The MACD continues to be negative and declining. The Swinland Trading Oscillator also declining, both based on price and volume. McClellan Oscillator starting to get extreme negative. We could still go lower from here, but this is sometimes when we see at least a try at a bounce. Stochc RSI pegged negative. Williams percent R pegged negative. Force index at the bottom and near the Kiltner band down here. So we're looking pretty extreme when you compare it with where we've been before. The rate of change, I keep saying I'm not going to show this chart anymore, but then it gives us another signal. After Friday, we were extreme. We bounced back up a little bit. After Monday, well, we're right back down here now again after Tuesday. Then I have some other rate of change charts that are suggesting some things to us. Going back 5 periods, we're pretty extreme negative right now. And if you want to pause this and look at what happened after we went extreme negative before, sometimes that marked the bottom. Looking back 10 periods, we're getting into extreme negative territory. And this was the extreme reading that we saw. Well, it didn't really help us all that much. This is where we started to see the bounce last March. But again, you can pause this and just match up what was happening and if this generated a good signal. But we may not be done going down yet with this. Here's another rate of change going back 20 periods, also giving us an extreme negative reading right now. Intermediate term, way below the 50 moving averages, way below the 100 moving averages. The PMO, the price momentum oscillator, declining. When we break it down based on price and volume, also declining. Our other PMO studies, those that are rising, getting to an extreme negative point. Those that are generating buy signals, really declining. Those that are above 0 is also declining. So you can see where we're seeing a real extreme negative technical picture right now, which could be a good thing, because this sometimes is where we get bounces from. BPI also, it dropped below 50 yesterday. Well, it continued to drop after Tuesday's session. Here's a longer term chart as well, but we still have more room to fall with this indicator if we want to use this to show that it's giving us an extreme reading, which it's not right now. Here's our rainbows. The pot of gold is quite far away right now. Here's the short-term moving average rainbow, intermediate term rainbow, and long-term rainbow. We're way far away from all of these right now. Stochastics, short term, extreme negative. Intermediate term, extreme negative. Long term, declining and not necessarily extreme negative. Summation index, declining based on price and volume, and we dropped below 0. This is one that I haven't brought up in a little while. It's the Sean trend meter. And this, I just brought it up because we're into this pink area, which is showing, in the past anyway, that this is an extreme negative reading as well. All of our momentum oscillators are negative, and some of these, like slope, you might say it's getting rather extreme, but it's gone lower. Before the MACD, it still has some room to fall. KST, Trix, PMO, TSI. Yes, these aren't necessarily giving us an extreme negative reading right now. The commodity channel index based on 14 periods, extreme negative. 20 periods, extreme negative. Chaikin money flow, declining. Vortex, negative, with the red line on top and the green line on bottom. RSI, getting down based on the 14 period, but not necessarily extreme, where with the 9 period RSI, we are getting into extreme negative territory. Balance of power, declining. And again, this is a newer indicator to me, so I'm kind of just riding this one out, but doesn't necessarily look like it's extreme at this point. Connor's RSI, declining and getting close to this lower band down here. Fibonacci retracement, we broke through the 50%. We tried to just regain that yesterday when we broke down, and now we're in danger of going down to the 61.8% retracement, going back to a significant low. The Ichimoku cloud, we are down out of the cloud right now. Bollinger Bands also starting to give us an extreme negative reading with the %B indicator right now. And this is another one I haven't showed. This is standard deviation. How far are we deviating away from the normal or standard price? When we get too far away from this, it acts like a magnet or a rubber band, and we're starting to really spike up. Now, we could go higher than this. We've done that before, but this sometimes can also mark a top. So we don't have a real absolute value with this indicator. That's why I plot the moving average on here, just to give us a bit of reference. Then this is another indicator that I actually developed, and then I found somebody else kind of worked out the hard part, and so I kind of merged what I was doing with what they did. I call this the boom indicator, and this is how far away do we get from a moving average. This top one measures how far away do we get from the 50-period moving average, and when we get to an extreme reading, this acts again like a magnet. Well, based on the 50, we're having an extreme negative reading. But when we look at it on a 200-day moving average, yeah, we're negative and we're declining, but we're not necessarily extreme at this point. Our trading systems, the Elder Impulse, we are negative with the S&P. We're negative with the SPY. The SAR, stop and reverse, is also negative because the dots are on top. Our different charts, Heiken Ashi looking pretty negative. Kegi looking negative. Renko actually drew in a couple of new boxes that are red, so that's bad or negative. Three-line break, also negative. Equivolume, lots of red candles going much, much lower. The ease of movement is really declining based on 14 periods and not necessarily extreme right now. Point and figure, no new signal, but we did add another 0. Long term, we are below the moving average on both the arithmetic scale chart and the logarithmic scale chart. The charts are exactly the same. I display these just to show how they look. Sometimes I find it better to use the arithmetic chart. Other times I like the logarithmic scale. Sometimes just looking at the same thing in a little different way will give you some kind of perspective that you didn't have before. The mega caps, they just got hammered. They were down over 4%. These are the big boys out there. And they are down, and we're starting to break below the low. The special K, this is our longer term trend measurement, also declining. Moving average study with longer term moving averages, 50 declining, 150 and 200 also declining, and not necessarily extreme. The rate of change, now this goes back 200 trading days. There's roughly 200 trading days in a year. So this is going back 200 periods. Now there's more than 200, but that's kind of the going conventional use of this. We are just starting to go negative with this indicator. And I'm not really suggesting that we're extreme. In fact, I have another one here. We're not extreme at this point. I just brought it up because for the first time in an awful long time, well, we went a little bit negative in March, and that was the low. And then we were able to bounce up out of that. Well, we have broken below that right now. This is going back even further. This is 250 periods, and we're just slightly negative. It's 0.86% negative right now. So this is just showing a real breakdown in the longer term moving average of the S&P. Here is just a longer term chart looking at all of the different indexes. Here's the S&P on the top, mid caps, which seem to be holding up a little better. And small caps are also holding up just, well, you could make a case for any one of these. Are we going to go test some of these lows? Are we going to be able to bounce up out of this? That's the question everybody's asking right now. The Dow Composite, it was down 2.4%. Dow Theory. Now, again, I'm not a Dow theorist purist. Okay, I just kind of look at these three indexes, and if they're telling me about the same thing, I like it. If they're showing me some kind of divergence, either positive or negative, then I try to point that out. I mean, there are thick books written just about Dow theory. But you can see on a closing basis how the Dow has been declining, the transports have been declining, and even utilities have been getting hit lately. This is a longer-term look. And I drew this on here years ago where I thought I was seeing something at that time where the Dow was making higher highs, where the transports were showing a negative divergence. But look what happened after that. Because that's one of the tenets of Dow theory is if you see a negative divergence, run screaming and yelling and sell as quick as you can. Well, if you followed this, you would have really left behind some good gains. So that's why I like Dow theory. I study it. I get some insight from it, but I don't rely on only that to look at things. The FANG stocks, they just got hammered down an even 5%. ARK, really having some trouble again, breaking through to new lows, down 6.75%. Here's the Dow. I mean, what can we say? Are we at any kind of a support level here? Possibly. But it's really, we're seeing a lot of open space right now. The diamonds are also negative and declining. Small caps, negative and declining, possibly getting to some pivot support. Mid caps broke through pivot support. So it's just not looking really happy right now. But we're oversold. So here's the NASDAQ. Also, we have broken through the lows that were set earlier in the year. NASDAQ 100 is right down to about the lows that were set earlier. NASDAQ 100, and then here's the VIX of the NASDAQ 100, or we call it the Vixen. Just love that name. Saw a real spike up on a closing basis, and the bar chart also spiked up, and we closed near the high. The QQQs negative and down right near support. NYSE composite. This is the one that had been hanging in there. Well, now we're starting to show some weakness. It was down 2.25%. Although we did not really exceed Monday's low by all that much. The S&P 100 really has been underperforming the S&P 500 over the last day or so. Wilshire 5000 also showing some weakness. This is another broader base index. Internationally, pretty much down across the board. the whole world's kind of not looking real good right now. All stocks were right down to this low again, at least on a closing basis. I don't use a bar chart on this particular ETF. Broad market, the dollar just continues to go up. And I'm going to point out something, but I'll wait until I get to the interest rates. But we were able to get above 102. And here's the weekly chart thus far. Then this is what I wanted to talk about. We need to keep an eye on the Japanese yen. I read some pretty disturbing articles over the weekend where Japan's having a lot of trouble, not only with the trouble like we're having in the U.S., but they're having a real debt problem. They're having problems with their bonds. They own more U.S. bonds than anybody. Well, than the Fed. The Fed owns a lot of U.S. bonds. And they might have to sell those bonds. And what could that do but possibly drive up interest rates? And they've asked the Fed for help, and the Fed said, sorry, we can't really help you. And I'm doing some more research on this. Well, this has also really helped the yen to decline against the dollar. And so I'm going to start putting a chart up here. Here's the Japanese yen on the top, and it just shows, and this goes back a while. I've been watching this for, well, it goes back about 10 years. This chart goes all the way back to 1980. So you're getting a real long-term look here. But we've really been breaking down, and we broke through the lows set back in 2015. The next chart is the euro, and the reason why there's this open space over here, the euro hasn't existed for as long a period of time, but it's been a lot stronger over the last 10 years or so, really the last 20 years, and that's been the main currency against the dollar. If the euro goes up, the dollar goes down, and vice versa. If you were to plot this bottom one, the US dollar and the euro, in many ways, they're like mirror images of each other. But we want to keep an eye on the Japanese yen. These are the three biggest currencies in the world. And the dollar is really showing some strength, where the euro and the yen is showing a lot of weakness. Okay, that might be good if you're a strong dollar advocate, especially if you live overseas or if you're looking to go on a trip. That can help your exchange rate. But this plays into a bigger dynamic that could be negative in the longer term. So I'm going to do more research. I'm going to try to figure out more what's going on here, and then possibly even do an extra video about this. But I just want to make you aware of this. And if you know anything about this, if you want to do some research yourself, please feel free to do that. If you find anything useful, feel free to send that to me, especially as an email. You can find my email address either at the end of this video, I always post it there, or on the YouTube channel. And it's also in the description on both YouTube and Rumble. And then oil got back above 100, and gold was up 0.43% based on the futures contract. It was up slightly based on the ETF, and it's just been darting all over the place. Here's the longer term ETF. Silver still continues to get hammered. Just love that joke. I'm a big Beatles fan. And here's the longer term view of the ETF. Bitcoin got spanked a little bit, got down into the 39s, was bouncing back a little right before I started recording. I don't own any Bitcoin. I don't trade Bitcoin, but I follow it. I find it very fascinating overall. And we're right about, we got back up into the 40s, I believe. But that could be different by the time I get done doing this. Here's some bonds. And I was going to wait and talk about this later with the yen. But since I hit that chart, I talked about it there. The only yield that is still inverted is the 10 to the 5. All the other ones, albeit not very much, at least they are positive right now. Here's the 10 to the 5, where we were at minus 0.03 yesterday. We're at minus 0.02 after Tuesday's session. Here is some Fibonacci numbers on the 30-year yield, which were coming back down after hitting that 3% level. And we're just showing a lot of bunching up. We're the last few days, interest rates have really been declining overall. And then this is where I was going to talk about the yen, because you can see how the red line is Japan, and see how all of the other countries have been spiking lately, even though we've seen some recent weakness. The U.S. is in the lead as far as the yield, but see how Japan really hasn't been doing all that much. In fact, they were negative there for a while, just like Germany was. And that's another thing we kind of want to keep on the back burner. Is this going to affect the euro and debt that the EU might own that belongs to the U.S.? But Japan is the number one after the Fed. So that they're kind of at the forefront of what I'm trying to do some research on. The World Bond Index was virtually unchanged, but bounced slightly. Corporate bonds saw a bit of a bounce with the current yield at about 3.92%. Junk bonds saw a decline. They tend to follow what the stock market does, and the yield is at 6.59%. And here's the junk bond ETF ratio against the bond ETF, where it actually declined a little bit. Bonds were up because yields went down, where junk bonds went down. Relative studies, gold against the S&P. Still looks like gold is outperforming. We're still hugging along this blue line, which is a 50-period moving average. The energy sector is still showing a much stronger breakout currently. Energy against tech just shows how energy's been doing really nicely, but then energy saw some weakness. Even though we bounced right back up, we were up little over 4% in this ratio on Tuesday. Here's growth in bonds. This is the one where it's like, okay, do you want crappy or really crappy? Take your pick. It changes from day to day. The ratio between growth and the bonds has really been breaking down overall. And this just shows that growth is underperforming bonds, which are also not doing very well. Here's tech against the S&P. It declined a little bit. I look at the percentage up here on the top. Sometimes it's a little hard to see because I use longer term charts here. This is tech against the 10-year yield. It just shows how tech is underperformed. And this is just showing how interest rates have been going up stronger than tech. And then this is the relationship that we've been watching. And we're getting right about back to zero now, which means not positive, not negative, not inverse, not in the same. So I'll keep an eye on this chart, but I'm probably not going to show this anymore now that we're pretty much back to neutral. What we had been seeing is as interest rates have been going up, the dotted line, we would see tech going down. Well, that relationship has weakened and is pretty much non-existent now. Discretionary, the things you don't have been really underperforming the things that you do have to have, where staples have been outperforming. And here's the S&P against the 10-year, which, again, as the S&P goes down, even when interest rates go down, this ratio still goes down. Here's the low volatility stocks. Yeah, they got spanked a little bit, but about half as much as the rest of the market. And then here just shows how low volatility stocks have been really outperforming the S&P itself. So what's our outlook for Wednesday? The technicals are negative. Surprise, surprise. Short and intermediate term, we are oversold, especially on a short-term basis, and we're showing some oversold signals even intermediate term. The markets, right now, I'm still saying it's a trendless intermediate term range. We might break down below this. We'll have to see how things go. The battle goes back and forth between growth and value. Supply chain issues, they're cracking down more on folks and making them quarantine in China, which could really have some supply chain issues for the U.S. Economic reports, what's coming out is pending home sales, advanced international trade in goods, retail inventories, wholesale inventories, and the weekly mortgage applications. I'm so used to using the word apps. None of these are necessarily huge market drivers. We're getting ready for the GDP advanced report, which will be coming out tomorrow. Geopolitical events, pretty much the same as what I've been talking about, and kind of I'm trying to mention these things as we go along. I added Japan right here because I did not like, and the article I read was in the Wall Street Journal, and if any of you subscribe to that, just do a quick search and look up Japan or the yen, and then Bloomberg has some articles about this. Reuters seems to have a lot of articles about this. So I'm not going to these offshoot news places. I'm trying to use more established sources to do some research. So what are our scenarios for things to keep going down, which is where we're at right now, if interest rates do pick back up? But we saw how they didn't really help things out. And then inflation fears, these could help drive stocks lower. The big one is probably that our technicals are negative. Any earnings or Fed-speak, I love that, Fed speak that comes out, that could spook the markets. Anything. The market may not even have a reason to go lower, and that's what often happens. A lot of times, the reason is found after it happens. So that's the negative side. If you're still looking for the ADX to cross above 20, you are still in a neutral pattern. And then positive. We need a lot of things. And some of these aren't even part of the scenario. These are potentially part of the scenario at some part in the future. I wanted to try to generate some positive things here. We could bounce because we're oversold, short term and even to a degree intermediate term. That could produce a bounce. And then if it can get some legs, that could turn things around. But first we need a bounce before we look at things actually recovering. Okay, then I have this long part B here. These are some different scenarios that are not, they're on the back burner right now. And some of them I've already been talking about. Longer term bottom signals. These are charts that I'm looking at. They could be setting up to generate signals. And they're pretty good at picking bottoms. I don't like to say that. It sounds disgusting. But anyway, these are still working, and it can still take some time for these things to draw. I don't really want to bring them up and make them as part of the video until we either see a signal given or we're getting close to a signal. Another scenario, there's a positive backdrop after the yield curve reinverts. Well, we still have one of the yield curves that I follow inverted. So that is not necessarily possible. And I should have had the word possible right there. The Staples ratio spike. I've been showing charts from time to time showing that when the ratio of staples to the S&P, when it spikes and then starts going lower, sometimes that will signal a bottom. We don't know if it's spiked yet. It's still going up. Then there's another one that I haven't talked about in quite a while. It's the 2-year yield spike. Sometimes when that goes up high and reaches a high point and starts coming down, that's when we mark a bottom in the market. We don't know. That's still spiking up at the current time. And then small cap thrust prior to the S&P 500 thrust. That's another chart. That helped us out pretty nicely back in the middle of March, where we saw a little bit of a bump up in small caps in relation to the S&P, and then not long after that, we saw a real nice climb from the S&P through about the last half of March. These are just in the background right now, but not viable. We're not seeing any chart confirmation of these yet. Then the technicals, moving averages and pivots may provide support, and if we even have to worry about resistance at some point, if we get some kind of a bounce. So negative, either you're in the 1 or 3 camp right now. And then because I like to look at all 3 sides at the same time, that's why I have the least likely one. That's why I have the most amount of words there, just so we can be ready in case that happens. So what's our conclusion? The S&P is negative, short term, negative but oversold, negative and becoming oversold, and in some instances is already oversold. Long term, we're negative because we're below the 200-day simple moving average. Here is a list of the different videos that I offer. Thank you very much. I hope you have a wonderful Wednesday, and I'll prepare the next video after Wednesday's session.